Good morning, everyone, and thank you so much for your time meeting us today. As you might have already seen from our announcement last month that we had a fantastic year. So just to summarize the top numbers, our year-on-year turnover increased by 71% to £84.7 million, and our year-on-year EBITDA increased by 79% to £4.1 million compared to year ending 2022. In today's presentation, we'll talk about our performance over the last financial year, and we'll also share our future growth plans with you. Just before that, I want to give you a brief introduction about our company. Hercules Site Services PLC is a technology-enabled labor supply company operating in the infrastructure sector. I'm Brusk Korkmaz, I'm the CEO for Hercules, and today I'm joined by our CFO, Paul Wheatcroft. As you can see from this slide, we've got a very strong and well-respected board with both exec and non-exec directors with great blend of experience in infrastructure, financials and banking, sales, PLC, governance, and even starting and then running an AIM-listed company. Together, we believe that we can grow Hercules even further. The next slide is about our business overview. On the right hand of this slide, you can see some of our blue chip clients that we work for in the infrastructure sector. As I mentioned before, we are mainly a labor supply company working for our blue chip infrastructure clients and complemented by our construction services division. Our labor supply division is our core business, and it is a significant part of our company, which currently contributes to 75% of our turnover, and this percentage is still growing. We have been supplying labor into UK's highways, rail, utilities, energy, and other infrastructure projects. And under the construction services division, we carry out civil projects in the water industry, and we also hire out our suction excavator services under the same umbrella. The biggest USP we have got is that we can supply all of these services by cross-selling opportunities to our clients under the same umbrella. Our clients prefer dealing with only one reputable supplier, who is in this case Hercules, rather than dealing with different suppliers, as it is more efficient and less paperwork involved for them to do so. Having our construction services division and our cross-selling opportunities also helped us retain our clients, as we have a high retention rate that some of the clients we started working with 16 years ago, and we have been adding on to this list since every year. The next slide is about our achievements for 2023. As I mentioned before, we had a fantastic 2023. Our revenue for the year ending 2023 is £84.7 million, which is 71% increase in comparison to year ending 2022. Our EBITDA is £4.1 million. Again, the increase is 79% in comparison to last year. And our EPS is 1.27 pence, which is 119% growth comparison to last year. As you can see from these numbers, we had a really busy and very successful year. We have been achieving these record numbers since I started Hercules 16 years ago. However, being on the AIM market has helped us accelerate our growth for the last 3 years. Our year-on-year growth for 2021 was 43%. 2022 was 51%, and last year 2023 71% accordingly. For 2023, we have seen growth across all of our divisions, and with regards to our labor supply arm, which is our core business, we had a great year also. We achieved £63 million turnover revenue and increased activity across all of our sites, including the HS2 Birmingham section, highways, and our water projects. With regards to our construction services division, our revenue is £20 million, and this is mainly due to delivering works in the water sector for the AMP7. As you are aware that there are huge issues with sewage being spilled into the rivers and into the seas. Therefore, we've been busy working for Thames Water, Anglian Water, and Southern Water projects. It does seem that the next AMP, which is AMP 8, starting next year, will be also hugely busy for us. I've got a slide later on to talk about the numbers about the investment spent on the AMP 8 comparison to AMP 7. As you're aware that there's a massive skill shortage in the UK, and it is very important for us to have a sustainable approach, which is finding local people for local projects, putting them to work and upskilling and cross-skilling our workforce. We also want to monetize this opportunity as well. Therefore, our training academy plays a very important role in the sustainable approach. In 2023, we have completed our construction academy, and we have launched our academy officially last week, Wednesday, which was the 31st of January. It was a great day, and on the day, over 150 people attended. And the next 2 days as well, around 500 people attended over 3-day periods, which is brilliant. And finally, in 2023, we have been concentrating on strengthening our relationships with our blue chip clients such as Balfour Beatty, Costain, Galliford Try, and Vinci, delivering more work for them. The next slide is about our revenue growth. As you can see from this slide, we've got a very strong growth history. I set up Hercules in 2008 from a family spare bedroom, and since then we have been growing every year. As you can see from this pretty slide, this pretty graph, there are several milestones that we've achieved over the last 16 years. Just to mention some of the significant milestones: winning the HS2 labor supply framework in 2021 for the Birmingham section with Balfour Beatty and Vinci joint venture. At the beginning of February 2022, we listed Hercules on the AIM market, so we are 2 years on the market. And this is a major milestone for us. We are very excited about being on the AIM platform, and we believe that this will enable us to grow as we have ambitious plans for our next part of our journey. We are aware that the current markets are not great due to inflation being high, interest rates being high, war is still going on in Ukraine, as well as COVID after effects. So we believe that this year the markets are going to get better, including the AIM, and it's going to catch up with our share price is going to catch up with our performance. We are very confident about that. As you can see from this slide, that our revenue has been growing since we started in 2008. And apart from the COVID year, you can see a bit of a drop and then picks up again. As I mentioned before, the last 3 years, we grew 43% in 2021, 51% in 2022, and 71% in 2023, achieving £84.7 million in turnover. Since the end of the financial year in November, we have acquired Future Build Recruitment. They're an excellent and high-performing company operating in the white-collar recruitment in the construction industry. This will add significantly to our exposure in the white-collar sector for the infrastructure and construction industries. Our clients have been asking for us to move into white-collar as well as supplying blue-collar. Now we started supplying engineers, project managers, project directors, and QSs, etc., for the sites, which is brilliant for us. As you can see from the top right corner of this slide, some of the government investment programs in rail, nuclear energy, renewable energy, and water sectors. So we are ideally positioned to grow even further for the next 20 years. Paul, next slides are yours.
Thanks, Brusk.
Thank you.
Hi, everybody. So this is our group statement for the last 3 years. You can see how things have moved on across those 3 years. Brusk has talked about the increase in revenues, 71% in 2023 over the prior year. Same comparison, EBITDA 79% increase, and earnings per share 119% increase. Few things worth pointing out in this slide. So our business is made up of a number of components, as Brusk has just explained. One of those elements, which is comparatively small, is the suction excavator part of construction services. That is what is accounting for the majority of the depreciation and the finance costs. Not all of it, but the majority of it. And you see that here. That increased in the year because we took delivery of 14 new suction excavators just before the end of March last year to make sure we got them in before the Chancellor's super deduction expired, which is of great value to us, and I'll explain about that in a minute. So they came then, and it's taken us some time to get all of those trucks up to utilisation. We're not quite back up to the same level of utilisation that we had before they were delivered, but we're well on the way. And we expect to get up to that same level around May time of this year. So we had the costs, we had the depreciation and the finance costs in that year. We were paying the operatives ready to be going out, but we weren't getting the utilization. If we were, I think the result for the year would have been even better. So coming back to the super deduction, how does that work? Well, effectively what it does is it gives you an amount of tax losses, which you never actually see in a profit and loss account or any annual reports. But effectively, we've got £14 million of tax losses captured by the end of September 2023. So on the basis of that, we're clearly not going to be paying any corporation tax for 2, 3, possibly more years, depending on how our results improve. The only other movement that you see on this slide between profit before tax and after tax is deferred tax. There's no CT in there. Deferred tax, is for those of you who are aware, it's just a bookkeeping movement that we have to do. Final point, but probably the most interesting one of all, that bottom piece does talk about earnings per share, and the earnings per share, of course, is very, very important. But in relation to shares, one of the issues we've had, and you'll be aware of this in the last year in particular, is the way that the share price on the market has just not been reflecting our results and our growth at all. You'll be very, very pleased to hear, and believe you me, we're very pleased too, to tell you, or those of you who haven't yet noticed, that since January, our share price has now increased by, I think it's about 43 or 44%. And we're really happy about this because we've known how well the company was doing. We know we've got a good story. We know we've got a great future. The market, we know, has been very, very difficult, but we think sentiment has turned. And the evidence of that is in the last, without shadow of a doubt, in the last 4 to 6 weeks, which is fantastic news. And we think it's got quite a bit further to go. There are 3 analysts' forecasts out there, which I'm sure you've probably seen, or by all means get access to them if you wish. But the consensus of those share price valuations is currently around 63 pence. I think as of when I looked late last night, I think we were almost 36 pence. So there's room to go. The highest of those analysts is actually 80 pence. So good for the future. Watch this share price. Next slide, please, Andy. This slide is all about labour supply. Again, shows you the last 3 years. Very, very solid organic growth here. No acquisitions affecting these numbers. We know we've got a strong pipeline. We know that strong pipeline is going to continue in the next few years. Well, how do we know that? Well, because our clients tell us, because we've got access to their online portals or specialized portals for suppliers like us, and we can see what they've got coming up, what they're bidding for, when they think they're going to want us to start. And because we are on all the frameworks and preferred supplier, strategic partners, etc., with all of those key clients we've got, we know that's going to come our way. We've had some new client wins. We always win some new clients every year. Part of our plan is to really be working with pretty much every construction company that we can in the infrastructure space. We gained Octavius onto the national preferred supplier list for Galliford Try, the entire national list. And more importantly, I think, in terms of size, is we won a contract with Balfour Beatty Rail. Now, we've never worked with them before, much as though we would have wanted to, but they had a bit of a shakeout. Every 5 years they review their list of suppliers. They had 12 on it. They dumped 7 of them and added us to the list. So we're now one of the 6 suppliers on that contract, and we're looking forward to growth coming along there in the next year or two. We've taken on a team of people, rail experience, to help deliver that growth. So with that and the white collar recruitment via the acquisition, which we'll talk about a bit later in the presentation. We see two nice areas of growth coming along to help us in the next year or two. So quite interesting, labour supply. Obviously, our major contract at the moment is the Birmingham section of HS2. We currently supply 25% of the workforce there, even though we're one of six. We're working a lot better than that. We're clearly doing a lot better than some of our competitors. In fact, we're always first or second on the list of the top suppliers on that site. I think the last time I looked, I think there was about 460 guys we've got on that site. Incredible. Across all the sites that we've got, including HS2, we've currently, since this slide was done, I think it's gone up a bit more. It's about 1,100 now. I think we've got across sites. This time last year, 750, so huge increase there. We've got two apps. People who've seen our presentations before might remember about those apps, but it's worth giving you an update on them. The recruitment app, which helps us to find people and match their locality with jobs in their area to suit their skills and qualifications. Last year, we managed to get over 8,000 people have downloaded the app and registered with us. That's now grown to 12,000, and it's growing every week. We've also got another app called the One Team app. Why is this important? Well, it's because it allows us to get people onto sites, onboarding them all digitally. We used to send guys in vans out with sheaves of paper to get operatives to sign them before they could start on sites. Those days have gone. We think we're ahead in this space, a lot further than our competitors are, both in terms of the recruitment app and the One Team app, and that obviously is a big selling point, we think, for when we're tendering for new business and also maintaining current business. Finally, training is a big issue. Obviously, we know about the skills shortage in the UK, but with labour supply, whoever we've got, none of the qualifications that these guys have last forever. Every 3 to 4 years, depending on what the particular qualification is, they have to be renewed. We've clearly been paying third parties to do that in recent years. We won't be doing that anymore. We'll be doing it ourselves via the academy, which we'll talk a bit more about shortly. And next slide, please, Andy. So this is about the construction services division. What does this do? Well, it does two things. It does civil projects in the water and sewage industry, working mainly on the asset management program, which is currently AMP7, which expires, I think, April of 2025. We've got a lot of growth in the last year on that one with Thames Water, Southern Water, Anglian Water, I think more recently Severn Trent as well. That element of turnover increased from 12.4 to 15.7 million pounds. The other element here of construction services is our suction excavator services operation. We've currently got 28 vehicles. I did mention earlier on that we had 14 more delivered just before the end of March. We think we've got a pretty good sized fleet now compared to our competitors in the marketplace. We've got no plans to increase this and to go any further with this. This, we think, is our sweet spot. It's a niche little business and provides us with some cross-selling opportunities within the group. The revenue on that business increased from 3.6 to 4.9 million. And as I said again earlier on, we probably could have pushed that higher if the utilisation, if we got that utilisation up a bit earlier than we have been doing. But there will be an increased performance on that business in 2024 and 2025. So overall, construction services, that's an increase of 29% in the level of turnover. And yeah, we're quite pleased with that. Next slide, please, Andy. For those interested in balance sheets, this is our balance sheet. What's changed? Well, the main change is, of course, we've doubled the size of the suction excavators. So that means our assets increase in value and our liabilities increase in value. The liabilities are because we've bought all of these suction excavators with conventional asset finance, or HP, if you like, and they're all being repaid over 7 years with fixed interest rates, and we put 10% down and got funding for 90%. Clearly, the ones that we purchased just before March 2023 were at higher interest rates than the ones we did when we started this business 3 years ago now, when interest rates were very low. In terms of the overall debt really comes down to the HP liabilities, including the suction excavators, and our invoice discounting facility. Again, for those who aren't aware of how labour supply works, we pay the operatives weekly. We send an invoice to our clients monthly, and then they're typically on 45-day terms to pay us the bills. So there's quite a long gap between us paying out the wages and getting paid for it. Therefore, some form of finance is required. And I think nearly everybody in our space has the same type of facility. We've actually changed ours recently. I'll give you an update on that a slide or two ahead. But the total debt on those two elements has gone up from 13.4 to 24.9. So because we're not adding any more to the suction excavator fleet, that HP or asset finance debt element is coming down every month now quite significantly. So debt's reached its peak. The only debt that may increase is the invoice discounting debt, depending on how much business we have and how fast the continued growth in the future is. Time will tell. Last point on this slide, which will make more sense when you see the next slide, is that our cash balance increased from 1.2 million in the end of 2022 to 4.1 million at the end of 23. A number of reasons for that, but yeah. Next slide, please, Andy. So cash flow, you'll see here that cash end year, that's the point I just made. You can see that change there. How have we changed this? Well, we've been absorbing cash really, and you can see in 2021 and 2022, we absorbed 5.3 million in 2022, and that was just the sheer amount of growth that we've had. Despite the even bigger growth that we've had in 2023, we've actually turned that round into a generation of cash, 3.88 million. A number of reasons for that, not one reason, but one of the biggest reasons is that we've reduced our labour supply debtor days from 75, as it was at the end of September 22, to 40 at the end of September 23. The way we did this really was, it was a poor position a year ago, mainly due to the Birmingham section of HS2. Again, for those of you who aren't aware, that operation is a contract being run by Balfour Beatty Vinci, which is a joint venture. And joint ventures, when they get set up, they have to set up all their systems, their management procedures. And that section is so big. It's the biggest part of all of HS2, and it's 8 different sublots. And they're all being managed and processed administratively wise independently. It took them quite a bit of time to get their act together on this, but at that point they hadn't got their act together at the end of September 22, hence causing us a problem. They have now, big time. We've worked with them seriously in the last year. They're now our most prompt payers. You can guarantee almost to the day when the cash is going to be received from them. So yeah, we're very pleased about that, and that's a good thing to know for future cash flow management. So we don't think we're going to reduce those labour supply debtor days much more. We think it's always going to be between 40, 45, and we'd expect that's where it should be. 2 other things that happened in relation to cash in the year. We did a fundraise to help working capital in spring of 2023 that raised gross £1.7 million. And we paid our dividends. We paid the final dividend for 2022 and the interim for 2023. during that year. And I think now the dividend yield is now 7%, which is very reasonable, I think, in anybody's books. Next slide, please, Andy. So what's happened since the end of the year? Three things that's worth talking about here. They're all quite major. We did an acquisition. We've been talking about doing acquisitions for some time. It's all about finding the right one and making sure that it is positive for our business and particular for our shareholders. So our clients have been asking us for white collar roles to be fulfilled for quite some time. And it's really not been something that we were proactively trying to chase. But we did try and see if we could do this on our own. But we came to the conclusion quite quickly that it would be better to find a successful operation that was already there that we could build on and work together with. So that's what we did. We found one. And you'll see the picture on the top right of this slide is when Brusk and I were in Brighton on the day of completion of the acquisition. The two handsome guys in the middle are Richard and Simon, who are the founders of that business. They started the business 10 years ago and they run it out of an office in Brighton. They've got 16 experienced consultants supplying all sorts of roles into the construction industry in the UK. They're in the sort of slightly different sectors and high-end residential, social housing, etc. But where are the synergies going to come from here? Well, we think there's some great future for this because their client base and our client base are completely different. Their candidate database and ours completely different. Their systems and ours completely different. So we fully intend to get the best of breed out of all of this and do as much cross-selling as we can between the clients to develop it as one business rather than as two. This isn't just one of those acquisitions whereby, which has happened with the recruitment businesses in the past, where larger companies like us buy small recruitment consultants. The key guys go away, have a holiday for 2 years, and then start up again in the future. We've done a 60% acquisition of this business and a 10-year partnership agreement. So the idea is here that at defined points in the 10-year cycle, they can sell their remaining 40% back to us at a pre-arranged formula based on performance. So they have a serious incentive to grow this business. At the end of the 10 years, we're guaranteed to have the 40% as well. So it will then be no later than 10 years, it will be fully integrated and 100% owned within the Hercules Group. The second point of change is, and again, I referred to this in a slide or two ago, we've had an invoice discounting facility with Investec, but that was for £11 million, and it wasn't sufficient for growth for the future because our growth just keeps carrying on, as you can see. So we spent a number of months looking at the market, and with the help of some consultants, we found a new deal that when we went for an IGF business credit, we now have a £15 million facility to help all organic growth and working capital needs. And that can be increased later on should our further growth require it. We think for the next year or so, that should be enough. But we're lucky we've got a partner who's very keen to fund future growth. Finally, the Construction Academy. And you'll see bottom right here is a picture for one of the classrooms or training rooms that you see at the Construction Academy. And we spent 2023 refurbishing and developing the building, which is in Nuneaton, quite close to the area of the HS2 Birmingham section, where there is obviously a requirement for a lot of people. And we had our formal launch of this last week on the 31st of January. We had a major amount, I think like 100, 150 people, somewhere in that range of people turned up, clients, prospective clients, all sorts of people, people who work in the industry, work in the training part of the industry. That's now launched, and now the hard work begins to develop that business and to start gaining the clients You'll be seeing a lot of marketing coming out, I'm sure, on that in the next month or so. Good question as to why are we doing it? Well, Brusk referred to it earlier on, skill shortage. The country can't expect all these projects to be delivered that's there on the list for the next 10 years or more without the right skills. So we've got to do our bit, and we think part of doing our bit is to get the labor available to the market, certainly available to us. So there are certain skills like steel fixers that there's just a shortage of. We need to tackle that shortage, and by virtue of running courses in the academy, we aim to do that. So this is not just as being noble. We also want a new income stream. We want to make some money out of this, as you would expect us to do. So we're going to get that income stream. It's going to come from a number of different elements. First of all, as I mentioned before, rather than go outside to train our own people when they need retraining, we will do that internally. That will save us money. We will also deliver courses for colleges, further education colleges, MVQs, etc. Our competitors, our clients, they've all got people that need training. But as well as that, any individuals who want to join the construction industry, don't have any qualifications, we'll offer courses for them as well. And we'll be very keen to make sure the courses that we offer are the ones that the industry needs. This is something that we think has got a further life. We don't think this is going to end with one academy, because if this is successful, and we believe it will be, because it's got to be, it's required, we can see the requirement for further academies, the next one in, say, 2-3 years' time, possibly, particularly in the nuclear industry. So we see that as a possibility, and that's something that we will keep our eye on, because there's lots of growth coming along in the nuclear industry, and Brusk will shortly tell you a bit more about that. So, Andy, next slide, please, and Brusk, over to you.
Thank you, Paul. This slide is about our current trading and our industry outlook. We had a fantastic start for this financial year also. Strong momentum has continued across all of our divisions into Q1 of the current financial year 2024. Infrastructure remains buoyant with £650 billion investment earmarked across our main markets, including highways, HS2 and other rail infrastructure projects. The next AMP, which is AMP8, where we are operating in the water sector, has a committed investment of £98 billion over the next 5 years, which is nearly double the amount of £51 billion investment in the current AMP7. Network Rail's CP7 investment plans of £44 billion investment into the rail network will be from this April over the next 5 years. As Paul mentioned, in 2023, we established our rail division to supply labor into the rail industry, and we became a framework supplier to Balfour Beatty Rail. So we are well positioned to maximize our revenue and profit in the rail industry. As you might have already seen in the recent news, that the UK government committed to major infrastructure projects throughout 2024 and beyond, including further investment in the nuclear energy, such as Sizewell in Ipswich and Wilfa in Wales. We are a strategic supplier to Balfour Beatty, and they've been awarded this project in Sizewell to deliver £30 billion worth of works. So Balfour Beatty are already in touch with us about this project because we are a strategic supplier to them, and we believe that we will be mobilizing on site in the second part of this year. As you can see from the list of these investments, we are well positioned in the market to further grow over the next 20 years. The next slide, please, Andy. This slide is about our growth strategy. It's our final slide. As you can see from this slide, we have multiple growth opportunities for our future. We've been growing across all of our divisions through a strong pipeline of projects into financial year 2024. As you are aware that there are billions of pounds being invested in the nuclear energy, rail and renewable energy sectors. So therefore, we are strategically positioned and we are strategically moving to these sectors to supply labor and white collar staff to bolster our growth. A partnership approach will help us to accelerate our labor supply growth following the Future Build acquisition. We have lined up a couple of partnerships to start in 2024. With regards to our M&A activity, we are already talking to identified acquisition targets in the labor supply sector. But again, our intention is not to go for something big for us to be able to acquire currently, because we are, our share price already lower than what, even though it has been going up for the last month or so since we announced our results. We don't want to be diluting on a lower share price, so we want to keep building this momentum. And if there is any opportunities come up, such as Future Build, as Paul mentioned as well, with Future Build, we have built up our own funds within our company from our profits to be able to purchase Future Build. And if any opportunity come up like that within the labor supply or white collar sector, we will consider that. But apart from that, there are no intentions of going and trying to acquire something big, because we are already growing organically 71% this year, 53 last year, and 40 plus 2021. So it shows that we can concentrate on the organic growth as well as ad hoc acquisitions such as Future Build. Last point, as I mentioned previously, we have launched our training academy last week, and we want to upskill and cross-skill our workforce to future-proof our growth, as well as we want to monetize this opportunity by selling construction-related training to our clients, colleges, and also individuals as well. This is the end of the slide, and thank you so much for listening to us today, and we really appreciate your feedback, and please feel free to ask any questions you like. Thank you.
A lot of questions. We'll dive straight into them. Firstly, HS2, and you were giving quite a lot of detail, Paul, about just how many of your operatives are active there. There's been a rescheduling or a change in the profile of the project. So could you say how much more growth you think there might be to come, and approximately how far forward might peak earnings be in the next year or two or three?
I think one of the things worth making clear, because there is quite a bit of confusion about HS2, the leg that the government have cancelled, which everybody will have seen in the news, is the Birmingham to Manchester leg. That actually wasn't due to start for 2 to 3 years anyway, so we'd not built any of that into our forecasts. This particular section, there's a lot of work there. We're going to be there for at least 6 to 7 years, probably longer, because it's a major project. And the numbers of people we've got there will undoubtedly grow. The guys there who are running this think that the next 2 to 3 years, are going to be the peak, and they're telling us that we're going to need to supply more people. What we never know for certain is the exact points in time when those numbers come through. But since the start of January, crikey, has that been growing. They're really getting into it to start the year. So where will that will have an impact on earnings, undoubtedly, and continue to have an impact on earnings for a good few years yet. But yeah, no concerns about that leg that was cancelled, because we'd never factored that in anyway.
You know, extending that, it's pretty near certain we're going to have a change of government. But you've both been, correctly extolling the virtues of a significant UK infrastructure investment programme. So a fairly obvious question, but I'm sure you get it a lot of the time. How might a change of government affect this? Will it have any effect at all when you're looking at nuclear, rail, water, etc.? It does seem to be a case for spending that must be made.
Shall I take that, Paul, if that is
yes,
all right?
please. Yeah.
There are quite a lot of investments being made in the infrastructure currently, and as you might be already aware, and some of them are already committed, and they started last year and starting this year. And with regards to nuclear energy and renewable energy, I think since the Ukrainian war, it showed that we need to be self-sufficient with energy supply and production in this country. And there are quite a lot of investments being made, I think, in the renewable energy as well as nuclear, and whoever comes into the, I think, government will carry that on. And both parties, I think, have mentioned that strongly. So I don't think we'll get affected with anything even more investment coming in the rail, as well as in the highways, as well as the AMP, which is the water sector. So yeah, we don't have any worries about who's coming to the government and who is not coming, because they all are aware that certain problems in the UK's infrastructure sector, and in order for us to be self-sufficient with transportation as well as energy, we need to, and water and sewage, we need to be able to spend money to be able to do that.
Yeah, makes sense. One for you, Paul, a working capital question. Given the two core divisions of the business, can you explain the different management requirements for you in allocating capital between labour supply and construction services?
Yeah. Well, it's the same issue with all of them, really. They've all got all the people who are working in both in construction services and in labour supply, they're all paid weekly. Some of the managers are monthly, but the majority of the headcount is weekly paid people. So the problem is the same. It's worthwhile saying that with the civil projects part of construction services, because of the way these types of projects are run, they work through applications for payments and you get certification. The process is a little longer to get to the point of payment than it would be with labour supply. And there is a perceived element of risk with civil projects, which, is when you do anything that's a fixed price deal, which is what these are. They're not all. There's some cost plus deals, but a lot of them is their fixed price element of risk. Even though we do incredibly well, we've got a good history of maintaining good margins in that part of the business. But because of that, when you're looking at invoice discounting, they tend to not offer you the same terms for civil projects as they do for labour supply. So say, for example, we can get 90% of the invoices for labour supply and the suction excavator services up front as soon as the invoice is processed. But with civil projects, we only get 60%. And that's because of this perceived element of risk. So it's not quite the same thing. You can't calculate debtor days in the same way with civil projects as you do with labour supply. But again, we've got a good track record in that space. So hopefully that answers the question.
I think it does. Bad debts. We have a question. Has this historically been a problem, presumably more with the private side than the government counterparties in the past? And in terms of risk, could you outline on receivables how much your largest client might make up as a proportion of total revenues in terms of perceived risk?
Yeah, I mean, Brusk was telling you earlier on about our list of clients. The vast majority of our clients on the very large blue chips, everybody will know who they are. We keep an eye on them, but there's no signs with them of any issues. The one spectacular one in the last 20 years, of course, has been Carillion. We never worked with Carillion. And there's particularly these large public companies, they have a great deal of scrutiny, and audit rules have increased massively in the last few years, particularly after Carillion. Now, does that mean that they could never go bust? Of course, that's not the case. Nobody can guarantee that. But we keep an eye on them, and we don't have any problems with them in terms of payments. We've had a few small. I think in 2023 we had 2 small bad debts. I think in total it came to about £90,000. Relative smaller clients rather than larger ones. And the only other one we had in our history, I think it was in 2021 rather than, it was either 2021 or 2022, which was a civil project, I think, which was a larger bad debt, which a number of companies were caught by. I think that was about £500,000. Having said that, because that business was picked up by another one of our clients, they gave us a lot of extra work to compensate for that, which never shows in the accounts, but tends to happen because our clients, the work needs to get done. It always needs to get done, and because we've got the good relationships, we've benefited quite well out of that. Again, hope that answers the question.
And Andy, just to add as well, when we are working for large infrastructure projects, there are project accounts are set by the joint ventures, which is backed by the government. So if any of that sort of companies go bust, they brought this in after Carillion. If any of the companies go bust, the government, HS2 or highways or Ofwat picks up that shortfall of payment. So this came in recently over the last 5-6 years. So we like Paul said, we had only one small debt last year and another one a few years ago. But again, we made that up because of the another client picked that up, so it gave us more work out of that.
Yeah, and I'm sure I've heard you talk about Thames Water before, Brusk, in terms of the way that structured work profile for water companies. And Thames Water continues to be closely monitored by Ofwat at the moment. But there are obviously people who are just asking if there is any perceived risk about the problems there for the work that you're doing with them.
Oh no, we don't really. We are working with main sort of contractors, Costain, Galliford Try, and companies like Balfour Beatty, Skanska on these projects, on these different sort of areas, and they are again, these work needs to be done. And with regards to Thames Water, that amount is supplied by Ofwat, and Ofwat gives funding for Thames Water to be able to upgrade their system. So that comes from the government where we operate, and if it doesn't work, if any of these companies sort of go bust, they will step in and give us the funds to be able to finish the project.
Good, very reassuring. A couple of questions about future build, or more specifically white collar work, and looking longer term. Are you hoping that the benefits to the group will come from being able to offer a larger, more inclusive offering to your large construction clients? Or are you also hoping to achieve better margins from the white collar work compared to blue collar? Hopefully both is the answer.
With regards to our blue collar, so our core business is labor supply, and we want to grow that. We can scale that up with our apps, like Paul mentioned, and white collar is a part of staffing in construction for us. So for us to be able to concentrate on the white collar and blue collar is perfect. It complements each other. So we can see our growth in the next sort of 2-3 years on that. So we believe that our percentage of 75% of contribution from the labor supply is going to grow up to 85-90% in total, because of the amount of projects coming up, as well as work within people required within construction with blue collar and white collar staff. So yeah, with regards to our margins, obviously white collar staff are paid sometimes more than the blue collar, depending on what level, and the percentages of uplift better with white collar. So our clients have been asking us to supply white collar staff as well as blue collar. So it just complements us, and we can sort of maximize that straight away.
It's worth adding to that, Brusk, that I suppose that a lot of what Future Build do is permanent fees, rather than they do some contract white collar like we do contract blue collar, but a lot of them is permanent fees, which can be quite good margins. And particularly because, as Brusk said, that they're higher paid, these people. So it's an interesting addition to us in terms of that extra margin. And the more permanent fees that they do, then the higher the blended margins will rise, obviously.
Great, thank you very much. And specifically on Future Build, it has only been a few months of them being in the family. Is it too early to see cross-selling benefits from the complete lack of client overlap? If it is too early, when do you think there might be fruits of that combination to talk about?
Yeah, and the great question is already started, really. We started supplying some blue collar labor to their clients because we don't work for the same clients. And we already opened up our blue chip clients for Future Build to supply white collar as well. And they had a really good meeting yesterday with one of our major clients to be able to get onto their framework to supply white collar staff. And yeah, it's going in the right direction. It started really fast, faster than we thought.
Great. Just a couple more questions to go. You mentioned margins earlier, Brusk. Hercules has done very well at delivering both revenue and margin growth in the civils business, which is quite a contrast to many others in the contracting sector. So can you explain what your magic sauce is?
Yeah, sure. So Andy, we specialize in the civil sector in the waters, in the AMP5. So we've been operating since AMP5, sorry, AMP5, AMP6, AMP7, and now AMP8. So we are 15, 16-year-old, a company have been working in the water sector, supplying labor, carrying out price projects, as well as cost plus projects as well, where there is no risk in the two elements of out of the three. Because we got a very, very specialist team. And also we don't want to grow our civil element as much as the labor element of it. We are concentrating on the margins a lot, and we've got a very, very experienced team to deliver in the water sector. They all help, as well as not everything that our civil projects does. Civil projects division has got risks for it. Because there are labor supply sides of it, as well as we supply suction excavators there. So generally, we believe that very, very minimal risk with the amount of specialism that is required, because there's also quite a lot of work coming up as well. Our clients are not tendering anymore; they are building up the price with us. So all they want to do is to deliver rather than concentrating on the price, and they are aware of the rates anyway, what's going on rates, and at the end of it, yeah, it's going really, really well for us.
Good. And last question, I'm afraid you're going to have to do this one, Brusk, because you've been there since day one. So the question is, what would you like Hercules to look like in 3 to 4 years' time? And will it be materially different in activities to now, or will it be doing a lot more of what it's already doing?
No, very, very good question. Our main focus is to increase our labor supply element with the white collar together. We are a labor supply company. 75% of our income comes from the labor supply. The amount that we have been growing, that element is growing the most with I mentioned about our apps, as well as a massive scale, the amount of work coming up. If I can give a few examples, A66 In Newcastle, over £1 billion project on the highways. A428 Black Cat roundabout in Peterborough, £1.2 billion. Again, we are working already on that, just started recently. A12 in Essex, another £1.3 billion projects. Lower Thames Crossing coming up, £5-6 billion projects. Northern and Southern sections, 2 separate clients won them, and we are a strategic supplier to them. CP7, that is the network rails infrastructure spend, £44 billion starting this April. AMP8, we mentioned. So there's so much work coming up, and there's a skill shortage. Also, with our training academy, upskilling and cross-skilling our workforce is important. We also want to monetize this opportunity as well. But with regards to our labor supply growth, that is a huge focus on that for us, and we believe that there's no reason that we can't be a £1 billion company over the next 7 to 10 years with £50-60 million EBITDA. That would be our ultimate aim.
Well, that sounds a very appropriate point to end on, and of course wish you best of luck at that. Our thanks to the audience for a very interesting, diverse range of questions. One minor task: you will be sent a questionnaire form, which I'm sure Paul and Brusk would be very interested if you can complete and pass back. Lots of materials, as we mentioned earlier, are available on the Hercules site, as well, of course, the equity development notes that have been written in the last year and cover the academy opening of last week. And of course, primarily thanks to both of you, gentlemen. Very helpful, transparent presentation, and we wish you all the best in extending that remarkable record of strong growth that Hercules has exhibited in recent years.
Thank you, Andy. Thank you, everyone.
Thank you, Andy. Thank you, everybody.
Appreciate it. Thank you.